Let's bring in Peter Boockvar, CIO of Bleakley Advisory Group and a CNBC contributor. Peter, great to have you with us. What did you make of the market reaction to the Fed today?
Well, I actually think Karen said it right earlier that it was just a positioning thing. When you think about the rest of the year, this was really the last major event. And since Powell sort of lined it up to what the market was expecting, it was enough to have this rally. And any worries that people have, say, you know what, I'll deal with it in 2022 and just reposition for the last 2 weeks of the year.
Hey, Peter, it's Karen. Thanks for coming on. Did you read, I guess, the half hawkish, and do you think we are at that maximum unemployment, so there's nothing stopping them from hiking?
Well, to what Steve said also was that they are speeding up the QE, obviously, ending it, and reiterating that they're going to go really slow with rate hikes. I mean, keep in mind, they raised 3 times next year. The Fed funds rate 75 basis points to 1, still deeply negative real rates. They raise again 3 times in 2023, and will probably have still deeply negative real interest rates. So it's a glacial pace of rate hikes, but the quick ending of QE. Now, and also keep in mind, QE influences asset prices and financing the U.S. Treasury. They're ending that quickly. That's $1.44 trillion program that's going to zero in a few months. Whereas what will directly impact economic demand is obviously the Fed funds rate and inflation, and they're going to go really slow with that.
Too little, too late is how we paraphrased how you stand, Peter. And so, what is the too little part of this all?
Well, it's really the rate story, because as I said, QE is just influencing asset prices. If you want to directly slow demand to recalibrate supply and demand, well, that's the Fed funds rate. And the Fed is telling you they may not touch that until May of June of 2022. And even when they do, they're going to go very slow in raising them.
So, Peter, when you look out on the spectrum here, and I talked about a recession, is this what you think the 10-year is worried about? Why it's stubbornly low? Am I focused on the wrong thing? You know, tell me why I should be looking at. And I know you're more pessimistic than myself on the markets, but what do you think the 10-year is telling us?
I think we have to look at the whole yield curve. If you look at the beginning of QE in 2009, it pays to steepen the curve when the Fed is easing, and it pays to flatten it when they're tightening. Because each round of tightening usually ends when there's some sort of accident or something breaks, which then results in them pulling back, whether it's the economy that buckles or markets do, and the Fed then stops. So to me, the flattening is just a natural reaction to the beginning of a tightening cycle, however slow or however whatever pace it takes place at.
So how would a portfolio be positioned then, Peter, for this, what you're calling big mistake of the Fed? I mean, how does this big mistake play out in the market?
Well, because they will be very slow in dealing with inflation, I'm still very bullish on commodity stocks, energy with oil and gas, agriculture, specifically fertilizers. I've been very bullish on gold and silver, which has been a painful trade in 2021, considering that the inflation story was right, but the metals trade was not. But I think that people were reminded today that, again, the Fed's going to be very slow in dealing with the inflation aspect with respect to demand, and that real rates are going to stay very negative for many years to come, and that gold and silver should be a beneficiary of that.
All right, Peter, great to get your take. Thanks. Peter Boockvar, Bleakley Advisory Group. So that's the Powell stumble basket, if you will. Steve, are you a buyer of that basket?
I'm still a buyer of the word transitory. I think that when we enter the first quarter, I think we're going to see a lot of the supply demand, flatten out a bit. I don't think we're going to have persistent inflation. So I think it's going to shock people that rates are actually going to come in pretty hard versus ratcheting up. So I wouldn't necessarily be a buyer of that basket.
Pete, I'm curious, what did you do on the back of the Fed decision today?
You know what? It was not so much of what I did on the back of that. It was before the Fed decision, because I think that, like I say, I think he's been extremely transparent, Mel, and he has been, I think, almost since he's been sitting in that big chair of his. So because of that, I felt very comfortable buying a lot of different things today. As a matter of fact, the option markets were telling me nothing other than, hey, look, there's upside to this. If I told you the number of technology names, semiconductor names that were hitting on the unusual options for the upside, the bullish side, you'd be absolutely shocked. And that was all morning, all the way up until that 1 o'clock, and then everything took off. Whether it's NVIDIA, you look at Apple, you look at Microsoft, you look at all of the different semiconductors. Marvell was one of them. All of those took off to the upside. So it was more of a preparation into it rather than waiting to hear the number and then reacting. And unfortunately, the options markets really did lay out a really great path for me today based upon, I think, how transparent he's been, and he stuck to the plan.